Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Take the puts, it's going to be the same thing. That I have the 6-week delta, my price. If I move out to a 15-week, the price goes up, but my delta goes down because it's in the money. If I go to the out-of-the-money options, the price is going up, but the deltas are also going up. It always comes down to when do you think this event will occur by? And I get this question very often is, which month should you buy? Short term, intermediate term, long term? My answer to that is you probably want to give yourself a little more time than you think you need. So the shorter dated options give you the most leverage. They're the cheapest, but if you're wrong on your timing, you could lose your entire investment. So if you're thinking 1 month, why not give yourself 2 or 3 months? Of course, that costs you more money. I do understand that, and you need to understand that. But a lot of times, traders, investors have told me I was right on my forecast, but I just gave myself 1 month. I should have given myself 2 or 3 months. So you have to balance those decisions. The entire risk-reward process it's complicated, but yet simple. Because once you understand the philosophy that you like to implement, you'll find the strike prices that are attractive for you, whether they're in the money, at the money, or out of the money options. And like I like to remind investors, there's no right answer there. So therefore, you might lean towards the at the money or the in the money or the out of the money. But quite frankly, you don't want to always be trading the in, at, or out of the money. You want to have, sometimes you're going to have a different viewpoint based on the market's viewpoint. So you can alter your decision-making process. Each strike offers unique risk-reward considerations. The greater the leverage chosen, the greater risk, with the potential for greater rewards, again, from the buyer's perspective. So the exchange rate is, of course, the major factor here. But you know what? The volatility is very, very important. Last year at this time, volatility was much higher than it is today. So in 2009, at least in the beginning, we had much higher volatility than we have today. All that really means is that the market is expecting not much movement all throughout, at least in the whatever period of time that you're trading, and that expectation is reflected in the option prices. So that curve, if you will. And the curve will determine the options prices, the extrinsic values. The intrinsic value we can easily calculate from where the exchange rate is relative to the strike prices. Let me just go through a couple of the symbols at the NISC. Again, we have a trading contest you can sign up for at fxoptions.com. You'll need the symbol, so if you're interested in the Australian dollar, that symbol would be AUM, and these are the spot currencies for those of you that have been trading the spot markets. British pound, GBP, the Canadian, the US dollar Canadian, the loonie, CDD, the euro divided by the US dollar, EUU, and then what's really important to understand is you have a base currency and a quote currency. The base currency is your first currency, the quote currency is your second one. US dollar, Japanese yen, YUK. So these are the symbols. Really important right here. The symbols are going to be very important. You would type that into your broker's account and you would get the option chains. You can trade based on US dollar as the base currency, and we have many of those, so we've actually turned around the Australian US and we made it US Australian. You would just type in these symbols. You'll notice the Canadian dollar did not change. We only have it as the U.S. dollar based. We also have the Japanese yen, same way. Mexican pesos, Swiss franc. So again, the convention is per USD. And we also have in USD. And this is to replicate the spot market for the Australian dollar, the British pound, the euro, and the New Zealand dollar. So it's that foreign currency, if you will, divided by the U.S. dollar. And the symbols, you would type in AUM, GBP, EUU, or NDO, respectively. And here's some charts. If you believe in charts, again, these are courtesy of Live Vol Pro. You'll see that the Euro USD, we're seeing a decline in the value of the euro. How do I know that? Well, if the prices are dropping, I look at the base currency, I know the euro is dropping relative to the U.S. dollar, symbols EUU. Now, that's the daily chart. What a friend of mine tells me is that he uses technical analysis all the time, but he says, I like to look at it in different time frames. So he looks at the daily and also the weekly, gives him a much longer perspective. So the weekly is giving us sort of a different view. The fact is, of course, that the euro had a nice run for a number of weeks, and now it's been selling off recently. So if your view is that the dollar is going to move up, you might want to buy EUU calls. And if you think that EUU or the euro is going to drop, EUU puts. British pound, U.S. dollar, see sort of a stable market here. Again, courtesy of Live Vol Pro. These charts are from chart.nu. You'll see a huge decline in the British pound over the last couple of years. Huge decline. And then stable market over the last, let's say, 5-6 months. Here's the Aussie. Here's the symbol AUM. Interestingly enough, just about 2 weeks ago, week and a half ago, we saw a new high in the Australian dollar. Commodity currencies were flying. What's happened since then? A decline. So depending on what your view is, if you think commodity currencies are going to rally, calls might be the play. If you think that the dollar is going to rally, looking at AUM, you might be looking at puts. Looking at a longer term, this is an amazing chart because you see a massive decline in the Australian dollar during the credit crisis in this period, and then a tremendous rally in the Australian dollar last April. From April through October, November, massive rally. What's important for us option traders, what's going to happen to the Aussie dollar next day, next week, next month, next 5 months, next 9 months. If you believe Aussie's going down, puts are available. If you believe Aussie's going up, calls are available. As you look at AUM, you could look at it from the reverse standpoint, AUX, and you just turn the calls and puts around. U.S. dollar Canadian, so we see a pretty stable view here. The U.S. dollar Canadian tried to make a new low beginning of the year, could not do it. And we've seen a massive rally, if you will. Even today, U.S. dollar was stronger against the loonie, and then sort of sold off a little bit at the end of the day. But now looking at a weekly chart, you'll see stability, and then a huge rocket up, and then rocket down. So that is the way the Canadian's been looking. And if you believe that the dollar is going to rally, what would you do? Looking at CDD, you might buy call options. If you believe that the dollar is going to weaken, you might buy put options. This is puts, calls.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.